Great. And it is my pleasure to introduce Chris Laughton and Carolyn Marlowe. Chris Laughton works for Farm Credit East and Carolyn is at the Farm Service Agency. They're both going to present some really great information on loans, especially some loans targeted towards beginning farmers. And Carolyn is going to start us off. Oh, and I almost forgot, if the attendees could just put your name, your farm name, and where you're located into the chat so we can just get a sense of who's in the room. That would be great. I'll go first as a model, and then I'll pass it off to Carolyn.
All right. Can everybody hear me okay? All right. So as MC mentioned, my name is Carolyn Marlowe. I'm the farm loan manager for the USDA Farm Service. Our offices are located in Norwich, Connecticut, but we actually handle the whole state. So I'm going to share a little bit about our programs today and what we have to offer. So I'm going to share my screen and hopefully that goes smoothly. All right. So my presentation here, can everybody see? Good. All right. All right. So we have Farm Loans 101. There are two functions that the Farm Service Agency provides. We do direct loans where the borrower or the farmer works directly with the Farm Service Agency. We make the loan and we provide supervisory credit, which is our role. And we also provide guaranteed loans where we work directly with a lender. Most often it's Farm Credit East. The lender services the loan and has communication with the borrower or the farmer, and our relationship is just with the lender. I'm going to focus mostly on a direct loan program and touch on the guaranteed lending further in my presentation. So direct loans are more specific or more applicable to our farmers here. So types of farm loans that we offer, we do farm ownership loans, farm operating loans. We offer an emergency loan program in disaster times. We also offer a youth loan program and a microloan program, which is under 50,000. And I'll touch on the uses and eligibility of each of those programs throughout. Something else with the Farm Service Agency is we have loan limitations. So for our direct farm ownership loans, we can lend up to 600,000. On our direct operating loans, we lend up to 400,000. Our microloan program is up to 50,000. The emergency loans up to 500,000. We can guarantee up to 1,776,000, and our direct youth loan program is 5,000. So some of our general eligibility criteria, there's quite a lengthy list of general eligibility criteria, but I have here some of the most unique and predominant eligibility that you'll find with the Farm Service Agency that you might not find everywhere else. So the first thing we have here is be unable to obtain sufficient credit elsewhere. Basically what that means is we are a federal agency. We don't compete with the local lenders in any way, and our program is meant to be a safety net, either for farmers that are just starting out or farmers that for some reason, don't meet the criteria for Farm Credit East. So that's part of our eligibility. You actually have to show that you can't get the loan from some other commercial credit source or through your own resources in order to be eligible for our program. The second point I have here is have acceptable credit history, which you'll find everywhere, but something that's unique about the USDA is that we don't look at your credit score, we look at the history itself and the whole report. So we don't have a threshold, you have to have a certain score. We look at the history, and then we're able to make exceptions if you have poor credit history. If it was something that happens that was outside of your control, like unforeseen medical expenses, we're able to lend in that regard, if it was something that was outside of your control. So we can make exceptions there. The third, I have be the owner operator of or a tenant operator of a family farm. USDA actually has a definition of a family farm, and it's that you're the operator. We only make loans to somebody that's producing agricultural commodities for sale in sufficient quantities that you're recognized as a farm and not a rural like residence, which is a little bit unique. Other lenders, they can lend to more agriculture related. The biggest example that's easiest to relate to is equine operations. I get a lot of calls for those, and we're actually unable to lend because there's no commodity being produced. It's just an agricultural service that's being provided. So that's an important thing to note about our program. So we're limited in that aspect. The last eligibility I have here is have applicable education, training, or farm experience. So we typically look for at least 1 year of farm management experience. Whether you operated your own farm, you worked on a farm, that's acceptable, but you had to have some sort of management responsibilities for our general eligibility. All right, so our operating loans. So our operating loans can be paid within 1 to 7 years. They can be used to purchase equipment, purchase livestock, and there's a caveat there would be breeding livestock. We can do production expenses, and then we can also refinance operating expenses. So any annual operating expenses, feed, seed, fertilizer, something that would be used within one production cycle, those are our annual operating loans, and the repayment has to come back within 1 year, up to 18 months, depending on the crop cycle. And then our equipment loans, livestock, and refinance, we can do for a term of up to 7 years. And I just have some pictures here on things that we finance through our operating loan program. We have a tractor and a little livestock trailer, and my adventures. Okay, so our farm ownership loans. The farm ownership loans can be scheduled for a term of up to 40 years, but our regulations, we're supposed to give the shortest term that's affordable based on your cash flow. So it can be as low as 15 years and up to 40 years. And this program can be utilized to purchase land, make major capital improvements like constructing a barn, some sort of facility. We can use it to promote soil and water conservation, and we can also use this program to cover like loan closing costs and expenses. Under our farm ownership loan program, we also offer a down payment program. This program is geared specifically to beginning farmers, and this is where the applicant comes in with a 5% down payment. And this is a joint financing program. So another lender would have to come in with a majority of the financing, and FSA would come in with 45% of the purchase price. Basically, these slides here can be a little bit confusing. There's a limit here where we can't finance over 300,000. So you have the lender coming in with 50%, FSA coming in with 35%, and the farmer coming in with a 5% down payment. So this program is actually very helpful, and I've used it in most recent years where farmers don't have a 20 or 30% down payment to meet the requirement of, say, Farm Credit East or another commercial bank. FSA will finance the majority of that down payment to meet the requirements of their lender, and then the borrower comes in with 5%. We guarantee the lender's portion of the loan, and our financing is at 1.5%. So it's a very low rate. And then our term on that can't go beyond 20 years, I believe, under this program. And again, you have to meet the definition of a beginning farmer. And that definition for USDA is you've been farming for less than 10 years, and you don't own more than 30% of the average acreage in your county. So that's the down payment program. We also do straight joint financing with other lenders. Again, if you don't have the ability to obtain all the financing from that lender, FSA can lend up to 50%, and that portion of the financing can be at 2.5%. In this program, no down payment is required, and you do not need to meet the definition of a beginning farmer. And here are some pictures. This was a tobacco farm that we financed back in 2017 with a farm ownership loan program. Then we have our microloan programs. So this program I see is the most applicable to beginning farmers. The microloan program can be used for both real estate and operating expenses. So it's both programs, and if it's under 50,000, it's considered a microloan. This is another good resource if you need money for a down payment. It's a simplified application process, which is it's paperwork, and their alternative managerial requirements for the operating microloans. So they require, if you do not have the 1 year farm management experience and you're able to obtain a mentor, a local farmer in the first year, then you can use that to become eligible for the program. And I'm sorry, also going back to our farm ownership loan program, if you're looking to purchase real estate with our program, we typically look for 3 years of farm management experience. There's some substitutions available, but again, at a minimum 1 year farm management experience. And there are substitutions for the 3 year requirement under the farm ownership program. And if somebody has specific questions, we can go over that in more detail. And our youth loan program. So I don't know if there's any youth, but if you have somebody that might be interested, this is a program for applicants that are between 10 and 21 years old. They need to be participating in 4-H, FFA, some sort of organization. And the FSA can come in and they can help this young farmer with a $5,000 loan to implement an income producing project. So we have here, we did one for cattle, and then we also did one for maple syrup production. So emergency loan program is another thing that we offer. This can be used for real estate and operating loan purposes. This program, you have to show more than a 30% loss. So I often find that it's easier just to apply for a regular, either operating loan or farm ownership loan program based on what your needs are, but this is also available. And this program, a presidentially declared disaster must be in place. Okay, so we have our application here. So we have all these programs here and how do you apply? So this is just a screenshot of our a regular loan application here, and I have the website farmers.gov, and you would apply to whatever FSA offices is servicing your area, which is my office if you're located in Connecticut, which is in Norwich. We travel all over the state to meet with people from Litchfield County over to Fairfield to Windham County. We're all over the place. So here I have some application tips. If you do apply for our program, a good farm business plan is critical. So I touched on our eligibility, which is a very important component of our program. If you're determined eligible for the program, approval is based on cash flow. So that farm business plan is critical in getting your loan approved with our agency. You have to show that you can repay the loan through the cash flow and through the farm business plan. In addition, the applicants should set and long-term goals. In regards to the business plan, always plan conservatively, keep good production records and financial records, and get help from the experts and ask us for help. So I have some more slides here expanding on that. So the supportive documentation is key for these farm business plans. 3 years of financial and production records for an established farmer is what we're looking for to support the plan that we're projecting. If you are a beginning farmer and you don't have the full 3 years of records to establish what your average yield is, what your average price is that you receive, the projected yields and price points need to come from a verified source for first-time farmers. So I have some acceptable sources here based on our regulations. that we also use to verify what you're saying. So in these plans, so land grant university and extension service enterprise budgets, USDA, beyond the Farm Service Agency, you have NASS, the National Agricultural Statistics Service, AMS, the Agricultural Marketing Service, RMA, Risk Management Agency, and ERS, which is the Economic Research Service. These organizations all put out reports on average commodity pricing, average yields that can all be utilized to support your plan. Also, you have local commodity reports. The Connecticut Weekly Ag Report has current auction prices, and then you have the local or Northeast terminal market prices. The best way to verify or support your plan is if you have a contract with whoever is going to be buying your products, establishing the quantity and price point. And then Farm Credit East also puts out benchmark studies for different industries within agriculture, I believe, and those can be really great supportive documentation as well. Other components of a good farm business plan, establishing a market for your product is the other thing I see that's very important. How will your operations stand out, and where are you going to sell these things? You know, you're producing all these commodities and they need to be sold. So, and lastly, the SWOT analysis is another really great tool. This isn't FSA regulations. This is just what I've seen. The SWOT analysis is your strength, weaknesses, opportunities, and threats. And I have a diagram here, which is great in analyzing your business. On the top, you have what's helpful to your business and what's harmful. So what's helpful is your strengths and opportunities. What's harmful is your weaknesses and threats. And you can analyze those further. The strengths and weaknesses are internal. So what about your operation is either helpful or harmful? And then external opportunities and threats from external, general market prices, weather, all of these things are important to evaluate. And then we have our guaranteed loan making program. The uses here mirror our direct loan program, farm ownership loans, farm operating loans, and operating lines of credit. USDA doesn't offer an operating line of credit, but we can guarantee them. A guarantee basically means it's a government backing of the loan from another lender. So in the event of a loss, FSA would compensate the lender and pursue the losses. So it just makes it more palatable for the lender, and it mitigates some of the risk for the lender. So provides credit to a farmer or producer that wouldn't otherwise be available. So FSA can guarantee up to 95% of the loan. And again, this program is where FSA, USDA works directly with the lender. So the borrower or the agricultural producer would work with the lender. We work a lot with Farm Credit East on this guaranteed loan making. Moving forward, we have our program funding. Our loan programs are funded by Congress. Sometimes the appropriations fall short. So especially at the end of our fiscal year, which is September 30th, there's always a chance we could run out of money. Usually we get the money within a month or two. It hasn't happened in recent years, but it's always a possibility. And these separate allocations for SDA, socially disadvantaged or beginning farmers, is our target funding. So I have a slide here. Socially disadvantaged applicants, there's a definition there. The main point is that FSA doesn't have a specific program for these groups. It's a targeted funding that is helpful, where if we do run out of money, there's pools for these groups that are less likely to run out of money. And same for our beginning farmers. There's not a specific program for beginning farmers. Everyone still needs to meet the same eligibility criteria, have an acceptable business plan, but our money is allocated to be more available for these groups. So I think I touched on this earlier. The beginning farmer or rancher is somebody that's been farming for less than 10 years and does not own a farm greater than 30% of the average size in their county. That concludes my presentation. That covers all the programs that we offer, and I have some more information. I have our staff here, me and Melanie Axley is our farm loan officer trainee, and then we have Sky Budney, who's our program technician. So it's just the three of us, and we run all over Connecticut. So, and our website here is farmers.gov. And with that, I'll open it up to questions.
There will be additional time for questions after my presentation. You can ask questions of both of us too, if you want to hold on.
Sure.
Either way.
Thanks. So hearing no questions, I guess I'll hand it over to Chris at Farm Credit East.
Okay,
Oh, I gotta
share my screen.
wait. I think I have to unshare mine. Oh, stop sharing. Hold on. All right.
Okay, so can you see my slide okay?
Yes.
Can you hear me? Okay, good. So I'm going to talk about a few things. I'm going to introduce Farm Credit East as an organization, talk about sources of capital that are commonly used to finance farms and businesses in general. I'm going to give you a little bit of background about credit scores because that's an important thing for lenders. I'm going to talk to you about the 5 C's of credit, which are kind of guideposts that virtually all lenders use. Cover some lender turnoffs, and then I'll talk about our Farmstart program, and then we'll have some Q&A. So Farm Credit East, we're part of the National Credit System. The Farm Credit System was established 105 years ago and provides credit to farming, commercial fishing, and forest products industries throughout all 50 states and U.S. territories. We are organized as farmer-owned cooperatives. Our particular organization, Farm Credit East, covers 7 Northeast states. We serve about 15,000 customers and have about $7.5 billion invested in Northeast farming, fishing, and forestry. And we also have programs specifically for young, beginning, small, and veteran farmers. So here's a map of the territory that we serve. We have almost 500 staff. Can you hear me okay? I got a thing that says my internet is frozen. Okay, good. We do loans and leases as well as a full suite of financial services. So we also offer things like payroll service, record keeping, consulting. We do more than 10,000 tax returns for farmers a year. We have a bunch of services like that as well. So financing your business. One of the things that we get asked a lot about from beginning farmers are about grants and incentives. Grants are great, but there's some caveats. One is that seeking and applying for them can be time consuming. They often come with strings attached. The grant maker is, usually it's not about you. It's about the grant maker trying to incentivize some type of public good. And that could be job creation, it could be energy efficiency, it could be environmental improvements, that sort of thing. The grant maker is not necessarily out to help you or your business per se. They're usually out to achieve that greater societal good. And that's fine, but that may or may not align with what you want for your business. So you want to make sure that your business goals align with the grant and they're not just the tail wagging the dog, chasing a grant that doesn't make sense for your business. And they could have outcome or reporting requirements. So sometimes the reporting requirements can be extensive. They'll want to know, how much water did you save on your irrigation system, or how many jobs were created, or whatever else. Depends on the grant, obviously, the extent of that. There's not a lot out there for startup ventures, unfortunately. Common grant areas are things like education. There's a lot of grants for nonprofits to do farmer education, and there's some for farms themselves to do demonstrations for other farmers. Energy efficiency is a big one, like putting in solar on the roof of your barn or putting in energy efficient lighting. There's grants for research, conservation, business development, that sort of thing. Most of them are for established. Having said all that, to help with the seeking part of grants and just finding out what's out there, we put together a report of grants that are available to Northeast farmers, and it's at this website address here, farmcredits.com/reports, and it lists all the grants that we could find at least that are available from federal, state, and local sources. So you can peruse that if you like, but there's nothing that I've found yet that would just give you a grant to like buy land and start a farm. So for capital, there's two main types of capital. There's equity financing, which is also called investment, and then debt financing, which is also referred to as loans. Equity financing is what commonly is used for startup or venture capital. If you take equity financing from someone else, it may require you to give up some ownership, like taking on a partner. Equity financing often to the investor carries a higher risk of failure because there's less recourse if the venture goes south. It usually comes from the entrepreneur themselves or relatives or an angel investor, or it could come from a venture capital firm. There's not a lot of venture capital firms that are active in agriculture. They tend to be more focused on technology and that sort of thing. Even the ones that are in agriculture, they tend to focus on ag tech. So that brings us to debt financing or loans. Sometimes people misunderstand what banks are really doing. Banks are lending money, and it's all about managing risk. So a banker, like a lawyer, always thinks about, okay, what's going to go wrong, or an insurance agent. Bankers think about, okay, what's going to go wrong with this investment? So they'll typically finance ongoing operations for expansion. You're unlikely to be able to walk into a bank with a business plan and a dream and walk out with cash. And that's true not just for farms, but when you're trying to start a dry cleaner or a grocery store or what have you. Typically, banks look to ongoing operations that want to grow and expand, and typically they look for ones that are at least EBITDA positive or cash positive, if not profitable. Pluses of debt financing is that it's usually cheaper. You don't have to give up ownership. The cost of lenders will typically finance up to about 80% of the value of an asset. So if you're buying land or real estate, they'll typically finance up to 80% of the value of that real estate. So that means that if you're buying property or something like that, you typically have to come up with a rather substantial down payment. Carolyn could talk maybe more about this, but I believe FSA does have a down payment loan that can be used to reduce that down payment to 5% rather than 20%, or I guess as little as 5%. You can use it for different amounts, and maybe when we get to Q&A, you could talk about that a little bit. But basically, I just wanted to kind of explain, where banks live, and Farm Credit, our core lending is kind of in that same category. Typically, it requires collateral and up to 80% of value. So that leaves beginning farmers with a bit of a nut to crack in terms of coming up with some startup cash in order to start a farm venture. And I'll talk more about our Farmstart program at the end of my presentation that we came up with to help bridge that gap. So there's a lot of different options available for credit. There's Farm Credit East, obviously, the Farm Credit System. There's the USDA Farm Service Agency. Sellers can be an important source of credit, particularly for real estate. Sometimes the seller will hold the paper, and you can make payments to the seller, either in until you acquire it outright, or for a certain number of years until perhaps your equity position is better, and it could be refinanced by a bank. There's commercial banks, of course. Then there's angel investors or nonprofits. There's several nonprofits that are involved in farms, and particularly in beginning One that's active in Connecticut is called the Carrot Project. There's another one called Dirt Capital. So there's a couple of those out there. And then finally, there's what are called CDCs, or Community Development Corporations, or Economic Development Agencies. They typically are mission-driven investors or lenders, and they will lend to businesses or firms that meet certain criteria that they, have as a priority. And those are typically like government-funded or nonprofit organizations. So I guess my point with this slide is just that there's not just one source of funds, and if one doesn't work out, there may be another that works better. So credit scores. I wanted to talk about credit scores because they're really important to a lot of lenders, including Farm Credit. And some of the aspects of credit scores are a little bit, I don't want to say counterintuitive, but they're not necessarily what you might think at first. So I'll talk about the 5 main factors that make up your credit score. The range is 300 to 850. Just like on the SAT, you get 300 points just for signing up. But 300 is, I've never seen a score of 300, but that would be terrible credit. Generally, 700 to 750 or higher is considered good credit. The higher your score, the more willing lenders will be to loan funds, and the lower the rate they will typically charge. Interest rates are based on risk. So it may seem somewhat counterintuitive that the worse your credit score, the higher the interest lenders are going to ask you to pay. And that seems a little bit like, kicking someone when they're down to some extent, but basically the lender is doing this to manage their risk. If your credit score is low, that indicates to the lender that you're a higher risk person. So they're going to require a higher rate of interest to make it worth them to assume that risk. If you have a very high credit score, you're 750 or 775 or whatever else, you're a solid bet. So you're going to get a much lower interest rate, and you'll get more competition to lend you money. Below 650 is generally considered impaired or subprime credit. So what affects your credit? There's 5 main factors. One is your history with credit, and this is by far the most important. So this is the number of accounts you've paid on time, the number of accounts that you're 30 plus days delinquent. Any bankruptcies, collections, or write-offs by lenders will, of course, hurt your credit. The number of days you're past due on a delinquent account will affect it, and the amount of any past due or collection accounts will affect it. So if you're past due or in collections for $100, that's one thing. If you're past due for $10,000, that's going to hurt it a lot more. So paying on time is just a really important thing. If you have credit cards and that sort of thing, and you can't pay the full amount, at least pay the minimum by the due date, and do the best you can. Number 2 is how much you owe, how much you currently owe on all credit cards and loans, the number of accounts you have a balance on. And what matters the most is not necessarily the total amount that you owe, but what they call your credit utilization ratio. And that's a fancy way of saying the amount you owe relative to the amount of credit available to you. And unused credit helps your score a lot. So to put that in an example, if you take 2 different people, you and me, say, and say you owe $1,000 on your credit cards, but your credit card is maxed out because that's what your credit limit is. And then you take me and I owe $10,000, but I have $30,000 available in my credit line. Even though I owe a lot more, my score is going to be a lot higher because my utilization ratio, the amount of credit I have outstanding relative to what's available to me, is less. And that seems a little bit counterintuitive, but what lenders like to see is that there's a lot of credit available to you, that other people are willing to loan you money. So unused credit helps you talk about that later. The length of your credit history matters, and the longer the better. And it typically factors the average age of your open accounts. So here you want to keep that credit card open that you've had a long time. So if you have a bunch of credit cards, let's say you have some credit card debt, and you're turning over a new leaf, and you're going to get yourself on a new financial footing, and you pay down on your credit cards, great, but don't cancel them. keep those credit cards, particularly ones that you've had for a long time, keep them open because that will lengthen your credit history or keep it long, and that will improve your score. Credit cards will often close your account on you if you don't use them for a year or more. So put like one little charge on there, even if you don't want to use it. If you have a better card that gives you cash back or something like that, and you don't want to use that old credit card that's not as good, just put like a magazine subscription on it or a utility or something like that just to keep it alive. That credit card that you've had for a long time will help your score. Now 4 and 5 matter a lot less than 1, 2, and 3, but they're factored into it. And this is one that I never really understood, but it's part of the mix. A mix of account types is better than just a lot of credit cards. So credit cards, bank loans, auto credit, student loans, etc. If your debt is spread out in different types, that somehow improves your score than if you just had one thing. But again, it's not a major factor. And new credit inquiries could affect your score. Each time you have what they call a hard inquiry, which is you're applying somewhere for credit, that drives your score down. And if you have multiple inquiries in a short period, that's considered a red flag. That indicates that you're shopping for credit and you maybe you hit financial trouble or something like that, and you're looking for money. That doesn't look good on your credit report. So for example, if you're shopping around for a mortgage or something like that, you want to make sure that you're not going all the way to the point of actually applying for more credit. You want to get quotes or estimates or soft inquiries, they call them, from lenders if you're trying to shop for rate, that kind of thing, rather than have a lot of hard inquiries, because that doesn't look good on your score. And sometimes if you're applying for a mortgage, they may ask you to explain recent inquiries and say like, okay, did this result in a loan that we should know about, because that hasn't been funded yet or that sort of thing. So there's a lot of words on here, but basically it's ways to improve your credit score. There's a lot of companies that advertise on radio that promise to fix your credit score, and I'm very skeptical of these companies. I think a lot of them are scams. There's no shortcuts to fixing your credit score, unfortunately. Many of these companies, what they'll do is they'll say that they'll correct any errors and dispute unfair charges, and that's fine, but you can also do that on your own. And if a ding on your credit history, such as a delinquency, if it's accurate, there's not much they can do about it. It just has to stay on there until it time's off. So ways to improve your credit score: if you have a lack of credit, say you're young and you've never really borrowed money before, get a credit card or a small loan and make payments on time, whether you need it or not. If you have impaired credit, the best thing you can do is make payments on time, pay down whatever debt you can, and avoid maxing out single credit cards. If you have to spread the debt out among other cards, that's better than having a card that's maxed. If you have a credit that's pretty good, but you need it to be a little better to get a loan, ask your credit cards for a limit increase, even if you don't need it. That'll lower your usage ratio. Lower your usage ratio. Having more credit available to you, whether you're using it or not. Well, if you're not using it, it's better. Helps your credit score. Avoid closing cards, especially ones that you've had a long time. And then obviously correct any errors and dispute things that are not correct on your credit report. As with Farm Service Agency, we look at your report more than your score, perhaps. So we look at different things on it better. In different ways. We're more understanding, for example, of student loan debt than if you have like a ton of credit card debt, even if it's the same amount of money. We see a lot of medical debt, unfortunately, that comes up, and you may have gone into collections or something like that, and you want to be able to know and explain anything that's on your credit report that's negative, and be able to explain that to your lender rather than have them find it and then be worried about it. It's better to be upfront with something that you know is going to be on there. So moving on to what a lender could be a farm lender or really any lender looks for. They call it the 5 C's of credit: character, capacity, collateral, capital, and conditions. And I'll go through them. So character is basically your performance on past credit. And obviously that's the content of your character is much more than that, but as far as a lender is concerned, that's what it amounts to. So they're going to look at your existing debt, how you've handled debt in the past. If you've had a lot of defaults, they're going to be concerned. And like I said, know what's on your report and be able to share and explain problems that might exist. There's 2 sites there that can give you your credit report for free. Annualcreditreport.com is the official site to get your copy of your credit for free. You can get 1 copy from each credit bureau, there's 3 main bureaus, per year for free. And what you can do to space them out so you don't wait a year between them is you can order 1 at a time and space them like 3-4 months apart. And that'll give you almost a whole year of sort of monitoring. You know, you don't have to ask for all 3 at once. They'll all have pretty much the same information on each of them. Creditkarma.com is another one that will give you at least your credit score. I don't know if it'll give you your whole report or not, but that's also free. So capacity, this for Farm Credit East is the biggest one because we want to get repaid. You know, we don't want to be in the foreclosure business. We want to be in the repayment business. So our concern is, what is your cash flow? What's your income look like? We're going to look at the past 3 years of your tax returns and see what your income has been like, whether it's farm income or off-farm income, and whether you can cash flow the loan out of that. If projections and budgets are useful, if the loan is going to improve your income by investing in, say, new equipment or new capacity, that's great. But if there's a lot of contingencies, if it's something where you're going to start this new business venture and you have to build a market and you have to find new customers and build a new product, and you know, all these different things need to fall into place to get income, we're going to be concerned about whether that's going to happen. You know, we're going to rely mostly on what your history shows of repayment capacity. And we want to know, you know, what's going to happen if things don't go as planned, you know, according to your business plan or your budget. Collateral. This is the lender's fallback position. Real estate is best. If you have property, you'll find that you can borrow against it pretty readily. Other things like livestock, machinery, and equipment and inventory can work as collateral as well. But one thing to consider is what is something really worth? There is what's called fair market value, and this comes into play a lot on like inventory and equipment. There's fair market value, which is what, you know, are. You know, if you sell it yourself and you allow plenty of marketing time and time for people to come and kick the tires and look at it, you can get one price for it. But a lender is going to look at what they call the net recovery value. They're going to look at, like, okay, if we have to collect on this collateral and sell it at auction, what are we going to get for it realistically? So that value is a lot lower. So you may find that your lenders are valuing your collateral lower than what you think it's worth. And again, they're just looking at their backstop position. And so it's, you know, you won't be able to borrow the full amount of what something might be conceivably worth, what the fair market value is. Capital is another big one, and that's basically whether you have skin in the game, so to speak. Ideally, your net worth would be at least 60%. If it's not at least half, then that's a problem. That means that creditors own more of your stuff than you do. So it will be harder to borrow money the lower your net worth is. Few lenders will finance 100% of any purchase. Farm Credit East typically goes up to 80%, as I said, for things like real estate or equipment. Conditions of the terms of the deal. Real estate, we typically go 10 to 30 years. Machinery and equipment, 3 to 7. Livestock, 1 to 3. And inventory, usually less than a year. The loan term should be equal to or shorter than the life of the asset financed. So in other words, like I've seen cars for sale out there with like 7-year terms for financing on them. And that's a little scary because what happens to a car when it's 7 years old? You're going to start to have repairs. Typically, the warranty is expired. So if you're making payments on a piece of equipment that also has significant repairs coming due, that becomes a very expensive asset to own while it's wearing out. So one of the things that I tell people is if you're financing equipment or something like that, try to cash flow it for no more than 2/3 of its useful life. If you can't do that, then you need to consider whether it's really a good investment. So just to recap how lenders arrive at a decision, they look at the individual, who they're lending to, the repayment ability of that person, their financial position and what they bring to the table in terms of capital or down payment. And then they consider how much risk is involved when they set conditions on the loan. So a few kind of tips. One is don't do what they call borrowing your last dollar. If you're doing a project or building something or construction, cost overruns happen. Things always cost more than you think they will. Sales often don't go quite as expected. You may have some rainy weekends in May if you're trying to sell flowers. Don't get caught because the lender is under no obligation to increase your line of credit or loan you more money if you run out of what they gave you on the first go. Capitalizing operational losses is something that is very concerning to us, and we get a fair amount of it. Farming is tough and it's cyclical. You have some good years and you have some bad years. And if you have a down year and you lose money and you need to pay creditors or vendors, or you have an operating line that you can't pay back and you need to term it out, we'll want to have a conversation about what's going to change so it doesn't happen again next year. And it should be something better than hoping for better prices. We'll want to know, how is your business going to change so that you want to capitalize a loss again the following year. We do this, we do loan against operational losses a fair amount, but we like to do it, maybe once, maybe twice. If we're doing it more than that, we'll be really concerned, because what that means is that you're eroding your equity. And the last thing we want to do is just keep loaning someone money on a money-losing operation until there's nothing left. Frankly, it's a disservice to the borrower, even though they may not think that way at the time. And then I mentioned don't finance beyond the useful life of an asset. Equipment, figure out what the useful life of it is and try to finance for no more than 2/3 of its life. Lack of commitment: when the going gets tough, the tough stick it out, the tough change their business model or their business plans, do other things. We still get occasionally people that throw in the towel or leave town or what have you when things get tough, and that's obviously not something that lenders like to see. So some more lender turnoffs. Poor records are a big one. We sometimes get loan applicants coming in and we ask them, okay, do you have records for your business? And what we don't want to hear is, yeah, I have a whole shoebox full of them. We'd like to have records that are meaningful and make sense. High existing debt. This is often a problem with young and beginning farmers, and I'll talk about this more in a minute. Low credit scores are a challenge. Relying too much on collateral. This happens sometimes with older farmers. They may have a lot of land, but their earnings are really poor. We don't really want to finance against a business that's not able to pay it back, even if they do have collateral. Unrealistic expectations, like I mentioned, too many contingencies or no plan B. And then lack of cooperation and commitment, and especially lack of communication. We often get people that are communicate really well up front, and then when things start to get tough, then they don't return calls anymore. They don't pick up the phone. They're not there when we visit the business. That never ends well. If things are tough, it's important to step up and acknowledge it and say, hey, I'm having a tough time. What can we do? Maybe the terms can be extended. or the payments can be shifted, or something can be done. But the earlier you have that conversation, the better, and the more options there are. So, as I mentioned, it can be tough to start any kind of business venture, especially a farm. So, because of that, about 15 years ago, we started a program called Farmstart. And this is a program that invests up to $75,000 in operating capital for new and beginning agricultural enterprises, kind of like 0 to 3 or 5 years. It's been going on, as I said, for 15 years. We've made more than 300 investments and invested over $8 million. It's not designed to buy real estate. There's not enough money in there for that, but it's designed to provide operating funds, and it can be combined with other sources of financing. So many of our Farmstart farmers may have leased land, or they may have land that's in their family that they're using, or some other land arrangement, or they could have a mortgage for real estate that they got, and that's great, but the mortgage is only going to give you the money to buy the real estate, and that gets you dirt. You still need to, maybe buy a tractor, or maybe hire some people, fertilizer, whatever you need. So this is designed to provide that crucial operating capital without collateral or down payment that's necessary. So it's designed for beginning farmers who might not meet traditional lending criteria. You have up to 5 years to pay back the funds. The rate is variable. It's prime +2, so it's currently 5.25%. And as I said, it provides operating capital for new or growing ventures. It can be combined with other financing. And we came out with this because we saw a lot of beginning farmers putting these kind of expenses on things like credit cards that were charging high interest. And so we put this together to provide an alternative for that. It's similar to Farm Service Agency's beginning farmer loan. A difference is that ours comes with what we call a Farmstart Advisor, and you're expected to check in with them at least a few times a year and let them know how things are going. Be willing to talk about your business and how things are working, and adjust your business model as necessary if things are not going as according to plan. So the Farmstart Advisors are really, we think, a critical part of the success of the program. So with that, I think I'm out of time and I'm out of slides, so I will entertain questions, and Carolyn can answer questions too, and we can have, I guess, open discussion. If there are any.
Hey, Chris, I see a question in the chat.
Okay.
If you don't mind. So It says, pursuing a loan from a bank, what is the relationship between the different interest rates from the bank and FSA loans? Is too high a bank loan interest qualify one to seek lower interest from FSA? And I think that's a really good question. FSA offers a lower interest rate typically than Farm Credit East. So our operating loan rate is 1.375 right now, and I think our real estate loan rate is 2.5%. Our rates come out monthly, and it's a fixed rate for every applicant for the life of the loan. Everybody that's in business wants a lower interest rate. However, when you go to Farm Credit, I think that their rates are hovering between 3.5% up to 5%. Those are the fair and going market rates in the lending world. So if you're able to get a loan from Farm Credit East at that fair rate, then that would be where you get the financing. However, if you go to a lender and they're willing to offer you 20% interest, well, that's not really the prevailing rate in the marketplace today. So then that could open up the door to coming to the Farm Service Agency. Does that answer the question?
Yeah, USDA and Farm Service Agency, and I believe SBA, the Small Business Administration, is similar in this respect. The commercial banking lobby, the American Bankers Association in particular, is very sensitive to what they perceive as competition from the government for their own business. So, so as a result, there's a lot of well, not a lot maybe, but there's some restrictions on borrowing from those government programs, and they typically like to see that you've been turned down first from a commercial lender.
You're right. And that's where our test for credit eligibility comes in. You do not need a denial letter right off the bat. We can usually make a determination, or I at least advise people to at least have a conversation with Farm Credit East first to see what they say. But that's where that test for credit comes in. We're not here to compete with the local lenders. We're not profit motivated. So we're just here to help people that can't get the credit. So that's our eligibility. Most of the things I see that inhibit people from getting credit, especially for beginning farmers, is a lack of down payment and a lack of available security.
And the other thing too is it never hurts to ask. You know, if you're not sure of your situation, Carolyn, I'm sure you're a busy person, but
I talk on the phone all the time.
Yeah, I'm sure you'd be happy to take a phone call and just go over some things with people and
I do it. It's sometimes a fun part of my job because I just get random people that call me, but I end up having some nice conversations with people, and I could tell them this is not a good fit for you. It's not going to work out, but we still had a nice conversation and now they're on the right path. So yeah, any calls, questions, I'm always free. So.
The question that came in is the NRCS High Tunnel EQIP program and loans like to pay for the structure until the repayment from an NRCS comes through. That's referred to as a bridge loan when you have a grant or a cost share or something like that that's going to happen. And sometimes these take 90 days or longer to come through. And so they call it a bridge loan. The problem with the NRCS High Tunnel EQIP program is that usually the volume, the dollar volume of it is so low that it's hard for us to do a loan. Really, you know, I don't want to be discouraging, but if there's something that's like less than say $7,000 or in that range, it's just the amount of work to put a loan together versus the interest received is not really there. And so it's
I'll build on that, or sorry, I didn't mean to interrupt you.
No,
it's the same thing with the Farm Service Agency. And the Farm Service Agency also, we don't offer bridge loans. We're actually unable to, so say for construction projects, we're not able to give the money up front. We're only able to give the money. So if you're building a barn, you have to dig a foundation, put the foundation in. So we disperse money as different phases of the project are completed. We are not able to give the money up front. So that's a little bit different for us. And another major component of getting a USDA loan for a construction type project is the environmental process. So if you call me and you say, oh, I just dug the foundation, but you know, I need a loan to finish this building, automatically we can't do it. We have to do a requisite environmental review before any construction takes place, any type of ground disturbance. So if you're thinking about financing any type of construction project with USDA, call us very early in the planning process so that we can get out there. What we look for is cultural resources, any type of extraordinary impacts to the farm property. And the main thing is that any type of ground disturbance that's taking place, we have to consult with the State Historic Preservation Office and the Native American tribes locally to make sure that the project isn't going to impact any of the cultural resources that might be present. So that's another big thing for us.
Yeah, at Farm Credit East, we don't have quite required. Okay, nothing against FSA. I'm not trying to, you know.
Yeah, exactly.
Good or bad.
It can be a pain, and it can be a pain.
Yeah. So we are a little bit more expensive in terms of interest rates. You know, there's that. FSA is always going to be cheaper, but you know, they don't always have money, and it's sometimes a process to get it. So, you know, we might be more flexible on some things.
Yeah, there's trade-offs, I think, with both programs.
But like I said, it needs to be a, you know, it needs to be a little bit higher dollar amount typically than what a
make it worth it to go through all the paperwork, especially with us too. Or I get people that need it, but there's only going to be you know, NRCS typically, if you're a beginning farmer, cost shares most of the project. So whatever's gonna be left over, like you say, is typically not a lot of money to make it worth it. But anyways.
But for more substantial grants, like if it's a REAP grant for, you know, putting in new lighting or something, and it's going to be $10,000, you know, we're definitely willing to do that.
Any other questions? No?
Well, we might as well wrap up then, I guess, MC.
Let's do it. And if anyone is, you know, digesting everything that they heard today, all of this really great information, and comes up with questions, I will send out our 2 presenters contact info in a follow-up email, as well as a recording of this session. And you, as always, can feel free to reach out to me at newctfarmers@gmail.com with any and all questions that you may have. Thank you so much, Carolyn and Chris, for this
Thank you.
presentation. And I really hope that we are able to support some of the farmers in Connecticut together.
Absolutely. Thank you so much for having us. Bye.
Pleasure.
Thank you very much.
Bye, everyone.